Everybody, my name is Theo. Today we'll be doing unrealized profit on closing inventory written down to net realizable value. Let's start off with a very basic example. Let's say, for example, Sub Limited purchases all of its inventories from Hold Limited at cost plus 25%, and Hold Limited originally purchased this inventory from a third party at a cost of 30,000 rands. And we also learned that the closing inventory in the books of Sub Limited was written down to net realizable value by 3,000. So the required says we need to calculate the unrealized profit on closing inventory. So the first step for me would be to draw up a table. The table is going to have the amounts column as well as the percentage column. Well, in the percentage side, we learned that profit is 25% on cost, so that means next to the cost you're going to put 100%. So our selling price percentage is going to be 100 plus the profit of 25% is going to give us 125% as a percentage for the selling price. So on the amounts column, we know that the original cost is 30,000, so we can use that figure and the percentages given on the percentages column to calculate the profit and the selling price amounts. We also know that the write down amount is 3,000, so we can use the selling price, write it down by 3,000 to get the 33,000 as the net realizable value. And then lastly, what is the unrealized profit? Well, it can be calculated in one of the two ways. You can either take the net realizable value of 33,000 less the original cost of 30,000 to get the 3,000 as the unrealized profit, or you can use that profit of 6,000 less the write down of 3,000 to get 3,000 as the unrealized profit. Also, guys, you need to remember that 30,000 is the original cost of inventory, and 36,000 is what Sub Limited paid for inventory from Hold Limited. Always check what's given in the question. And also remember that if profit is more than the write down to net realizable value, there will be consolidation journal, like our example. And if the profit is less than the write down to net realizable value, there will not be any consolidation journals.
Okay, so now that we have calculated our NRV, we use this as our closing inventory balance in our table. And in order to work out our opening inventory balance, we are told that they sell their inventories at cost plus 25%, which means we simply take our opening inventory balance amount of 13,500, times it by 25 over 125, which is what we want over what we have, which gives us an amount of 2,700. We then put this into our table as our opening inventory balance and complete the rest of our table. So now that we have completed our table, we can use this to complete our consolidation journal entries. First, we start with opening inventories, where we debit the retained earnings by the net amount in our table. We then debit deferred tax by the tax amount from our table, and credit inventories from the unrealized profit amount in our table. This is in order to eliminate the unrealized profit in opening inventories. This same inventory amount is then debited along with cost of sales being credited. These first 5 entries can, however, be summarized into these 3 entries. The tax effect is then realized by debiting income tax expense and crediting deferred tax. So the next step is to eliminate the intragroup sale of inventories for the current year. This is done by debiting the revenue of the selling company and crediting the cost of sales of the receiving company by the full amount of 79,500 Rand. We then move on to closing inventories, where we use the full unrealized profit amount, or NRV, to debit cost of sales of the selling company and credit inventories of the receiving company. This is in order to recognize the unrealized profit in closing inventories. Then finally, for the tax effect, we debit deferred tax and credit income tax expense by the tax amount for closing inventories. This is in order to capture the tax effect of unrealized profit in closing inventories.
For the analysis of owner's equity of the sub, it is only affected when the subsidiary sells to a parent. It affects the since acquisition section and the current year section. We'll start with the since acquisition section. It affects the calculation of retained earnings. You start with your balance of retained earnings and you deduct your opening inventory because that profit has not been realized. You also use the after-tax amount. For the current year, it'll affect the profit for the year. You'll use the balance of your profit, add back the opening inventory, the after-tax amount, and deduct the closing inventory, also the after-tax amount.
Good morning. Today we shall be looking at the changes in the statement of profit or loss, or other comprehensive income. As which, there are three main issues that we shall be discussing. The first is that of the elimination of the intragroup sales between both the subsidiary and the parent. The second will be adjustments made to the opening and closing inventories for the unrealized and realized profits during the year. The third one is the tax effects thereof. There are three main line items that will be affected. First is revenue, then cost of sales, and finally the income tax expense. For the first issue, the elimination of the intragroup sales between the parent and the subsidiary, the eliminations are the same. You should eliminate this amount from the revenue, as well as eliminating this exact same amount from the cost of sales. This is done both when the parent sells to the subsidiary and the subsidiary sells to the parent. The second issue is the adjustments made to the cost of sales to account for the unrealized profit in the closing inventories and the realized profit in the opening inventories. The opening inventories realized profit needs to be eliminated, as this is an adjustment to the opening balance of the retained earnings. The closing inventories for the current year needs to be added back, as this is the unrealized profit for the current year that could have been potentially sold to a third party. This is done in the subsidiary's cost of sale when the subsidiary sells to the parent, but when the parent sells to the subsidiary, it should be done in the parent's cost of sale. Finally, we look at the income tax expense that needs to be adjusted. An opening inventory profit is realized during the current year. This is an increase in profits, which means an increase in tax, which means we add back the deferred tax from the previous year to the current year's income tax. In closing inventory has unrealized profit. This is a decrease in our profits, which means that we should decrease our tax, which leads to lower income tax for the current year. Next, we shall look at the statement of changes in equity.
We are going to take a look at the effect of unrealized profit on inventory written down to net realizable value in the consolidated statement of changes in equity. It's going to affect the retained earnings, the profit, and the non-controlling interest. We can have two scenarios where the parent sells to subsidiary or the subsidiary sells to parent. Now let's have a look when the parent sells to subsidiary. When the parent sold inventories of 10,000 rand to subsidiary for 15,000 rand at 31st December 2013, the financial year end. What's going to happen with the profits, which is 5,000 rand, we have to deduct it because it's not recognized. It's an unrealized profit. So we are going to deduct it from the profits of the parent, but we are going to add it back again in the beginning of the financial year on the retained earnings. We are adding it on the retained earnings of the parent, but then there is a write down of 3,000 rand of the inventories. That means the net realizable value is 12,000 rand. Now in this case, the profit is no longer 5,000 rand but 2,000 rand. So we are going to deduct from the retained earnings which we have added 5,000 rand. We are going to deduct 3,000 rand. Bear in mind that the retained earnings on the statement of on the consolidated statement of changes in equity, we take 100% of the parent and the percentage of the subsidiary.
For the consolidated statement of financial position, it'll be the same for both when a parent sells to a sub and when a sub sells to a parent. So it'll affect the current assets section. The deferred tax will be your closing inventories deferred tax of 280, and your inventories will be 100% of the parent plus 100% of the sub, and you deduct any intergroup transactions, in this case 1,000 rand.